the dangers to the bear market rally. So we know that we've got a bear market rally going. Where are we in this process? Highlights. The retracement is holding at 50%, typical for a bear market bounce. Bearishness has subsided throughout the retracement. This, so far, to date, this is pretty much what you would have expected the first bounce to look at. I detailed that in the last couple of calls, and I'll just show you a little bit of that as well, too. The economic data appears to be the worst since the Great Depression, if not ever. 20% unemployment happened without social unrest. The reason I bring up social unrest is I don't want to get deeply into any kind of a bearishness story. What I'm suggesting here by using that provocative term, social unrest, is there is 26 million people that have filed for unemployment claims. They're going to have a limited set of patients waiting for a job to come back when they've lost their job because of a government shutdown. Unless you want to make the case to me that we've got 3, 4, 5 million job creation months coming, you know, at the end of the summer, I think that their patience is going to run thin, and that's going to lead to some problems. That's all I'm trying to suggest there with that. Now, I'll talk about that when I get there. The real question is what long-term damage changes will occur with the restart. Early data suggests that the changes result in slower growth. Everybody is still stuck in this mentality of let's talk about the second quarter, let's talk about the third quarter restart. When are we going to restart? Is it going to be May 1st? Is it going to be Friday in the case of Georgia, Tennessee? Is it going to be the end of May in the case of New York? And what that means. We know there's going to be a restart. We know there's going to be an uptick in activity. Where are we going to be after that? That's the real question that is not being addressed. And the early data suggests that there's going to be lower numbers. Earnings continue to sink, really impossible to make a value judgment. In fact, it's impossible to make earnings because well over 150 companies have withdrawn guidance. They're telling you they can't make guidance judgments, but yet Wall Street seems to be making these judgments, and Wall Street seems to be, as I've been criticizing them for a month now, is take every optimistic assumption when they put together their earnings numbers, and I still think that they're way too high. If you took any kind of traditional measure, the stock market is now overvalued. Talk about that. And then energy has opened the world to negative prices. This can lay the groundwork for financial crisis. I want to explain that when we get there, because this is really a microcosm of the fear of missing out. Everything is a buy mentality. The Fed will take care of every problem. Is all rolled up into what's happening with the oil ETFs and with the oil market as well too. So I'll save that for last, but I do want to detail that as a window into what's going on. And yes, it could be the catalyst for a financial crisis if it goes wrong. Hasn't yet, but if it does. But let's start with the major ones with the market. So slide 3. February 19th was our high. 1 month ago today, March 23rd was the low, a 33.9% decline. That is the biggest, fastest decline off of an all-time high in market history. Nothing comes close to that. Not 29, not 87, not 1871, 1937, take your pick. Nothing comes close to that. To date, at the high, we did a 53% retracement. That is very common for a market. And I think that retracement is the best metric to use. Yeah, it's 28%, but this was the biggest decline in history. As I've always said, every move is a function of the previous move. I could have told you at the bottom that if this is the largest move we've ever seen off of a high, I could have said whenever the rally comes on a percentage term, it'll be one of the largest rallies in a short period of time we've ever seen, because the previous decline sets up the next rally. So a better, more objective metric is to look at retracements. We did a little bit more than half. And yesterday's low, we were at the 50% line exactly after the first couple of down days this week. 1929, 1973, the first rally in 2008 actually did 75%. The second rally did 50%. In 2007's first rally did 75%, made a new low. Then coming off Bear Stearns, we did a 53% rally. We did exactly what we did right now. 1929, we did a 52% rally. 1973, we did a 50% rally, a little bit more than a 50% rally. This is very common to have the market do this kind of rally off of the first decline. And the purpose of that rally is slide 4. It's to get everybody to think